want to talk about some stocks that are working in the stay-at-home trade. Joining us right now is Mark Mahaney, RBC Capital Markets lead internet analyst. Good morning to you, Mark. You know, one day some of these tech companies are loved. The next day they're not because everybody thinks the vaccine is coming. Then they're loved again. None of this makes sense.
Well, I think that the trading mentality actually does make sense. And you have had fundamentals materially improve for what are generally considered in the internet space the stay-at-home winners. That was Amazon, Shopify, Etsy, Wix, Netflix. You had record sub-ads at Netflix because of the COVID crisis. You had material acceleration for almost any internet retail name. So the stocks did follow those fundamentals. You're going to have trades up and down. My sense is if you look at these names, you want to find those names that actually the ones that won that really took advantage of the crisis. I don't want to put that in such a negative way, but did something to really expand their competitive moats or increase their value proposition. Amazon comes to mind. Look at what they've done with their logistics footprint. They've increased it by 50% during this period of time. They've spent something like $11 billion this year building out more of that distribution footprint in local areas so they can get products, shipments to consumers faster. So I think they are near-term and a long-term winner from the COVID crisis. We're also, though, looking for recovery plays. Uber's at the top of our list for recovery plays. And it's somewhere along the way, it's going to be a travel name, too, like a Booking or an Expedia. I just think that's going to be a very long recovery path. So I think people can be very cautious or slow in how they build into those positions.
Mark, but all of these stocks require you to believe that the multiple is sustainable. And so that's the question I would ask you, because that's almost a psychological behavioral science question about how the market wants to treat these companies.
No, you asked the right question. So we actually did a screen of all these companies to see who had re-rated the most. And I know Netflix has gone up a lot this year. I know Amazon has. Guess what? It's because of earnings and revenue growth rather than multiples. So that means the move year to date is more defensible. It's more sustainable. The ones where we've seen the greatest re-rating, there's two names in particular that I get a little bit nervous about, but they're not the obvious COVID winners. They're kind of the mid-tier advertising names, Pinterest and Snap or Snapchat. Those are the ones where we've seen the most re-rating. So those where the year-to-date moves may be the least defensible. You may see a bigger pullback in those names. If it hasn't been, if the stocks have moved up because of the estimates, that makes the stock a lot safer, and it means they've got another leg of growth if the fundamentals continue to climb.
Mark, not to labor the broader valuation point, but I know you caught up with Mark Andreessen at your conference this past week. What did he have to say about the broader valuation of the tech sector compared to other peaks in the last couple of decades, which he knows so well?
Yeah, he does. He made his simple point was that you've had this material re-rating, especially in software, for two reasons. Because software has become a subscription business, the duration of the offering is longer than it was in the past. Secondly, for a variety of technical reasons, some really simple things like broadband, the worldwide adoption of broadband and faster distribution speeds over mobile channels. You've expanded the TAM for anybody selling software to a global market. That wasn't the case 2 decades ago, 3 decades ago when he started Netscape, 3.5 decades ago. So that's why the multiples can be higher in software. That probably, whether they justify them at this level or not is another question, but that there should have been a multiple expansion because you increase the duration of the value proposition of software, you increase the market of software. That's why the multiples should have gone up. I think it's a reasonable point.
Mark, I know you cover the sort of tech-enabled travel stock as well, like Booking Holdings. Do you think they're going to react more to the short-term headlines of virus cases spiking or the hope for the vaccines around the corner?
I think they're going to get, unfortunately, I think they're just going to get whipsawed. We had Glenn Fogel, the CEO of Booking, at our conference this last week, and he was very clear. He's looking at a recovery that's years in the making, not quarters in the making. Glenn is generally a very buttoned down kind of person. He's not going to raise expectations. And near term, we saw several companies talk about trends deteriorating in the December quarter versus the September quarter. The travel names are at the top of that list, names like Eventbrite that are involved with live events. So the stocks will jump back and they're going to jump back and forth. I think you have to be very careful with travel names. I just don't think the fundamentals are going to justify a big upwards move from here for maybe another year at least.
Shepard Smith here. Thanks for watching CNBC on YouTube.